Hello, welcome to the series of videos for this week. In this week, we are going to extend our learning from the fundamentals of last week. This is the first opportunity for you to prepare a set of accounts for single entity. There will be two videos for this week. The first is based on IAS 1, which is International Accounting Standards 1 for presentation of financial statements. The second video will be based on Statement of Changes in Equity and IAS 8, which is accounting policies. First, the learning outcome for this week. At the end of this session, you should be able to understand what the objectives of financial statements are, the components of financial statements, the general features of financial statements, the frequency of reporting of it, then identify some of the financial statements components. Then we'll home in on statement of financial position, the statement of profit or loss, and other comprehensive income, which we will refer to as the statement of comprehensive income, the statement of changes in equity, and the notes to the accounts. First, let's focus on IAS 1, presentation of financial statement. This standard is a cornerstone accounting standard, and it includes the components of financial statements, the very core concepts of financial statement, and discusses the concepts of true and fair override. IAS 1 states what the objectives of financial statements are. According to IAS 1, the objectives of general purpose financial statements is to provide information about the financial position, financial performance, and cash flows of an entity that is useful to a wide range of users in making economic decisions. Again, we discussed this last week when we mentioned that the users are varied, and therefore the financial statements must provide information about financial position, which is usually called the balance sheet, a snapshot of a photograph of the financial affairs of a company or an entity at a particular point in time. The financial performance is a statement of profit and loss, the cash flow as well. So this should be useful to a variety of users, enabling them to make economic decisions. The information is presented in these four primary financial statements together with a set of accompanying notes. So what are these four primary financial statements? The first of which is the statement of financial position. The second is the statement of profit or loss and other comprehensive income, or statement of comprehensive income. For the sake of brevity, the statement of profit or loss and other comprehensive income may be referred to as statement of comprehensive income. So from henceforth, I will refer to this statement as a statement of comprehensive income. The third is the statement of changes in equity, statement of cash flows, IAS 7, and the notes to the accounts. Statement of cash flow is not part of this syllabus, but you will study this when you get to level 3. What are the general features of a general purpose financial statements? Well, the main ones are there should be fair presentation. It must comply with international standards and the going concern basis or concept which we mentioned last week. This idea of accruals basis, again, we'll explain that concept shortly. Materiality and aggregation, offsetting, the frequency of reporting, comparative information, and the consistency of presentation. So these are the areas covered by IAS 1 that we are going to discuss now. Fair presentation and compliance with international standards. IAS 1 does require that financial statements must present fairly the financial position, financial performance, and the cash flows of the entity to which they relate. Therefore, it is assumed that the application of international standards will result in a fair presentation. An entity which complies with international standards must make an explicit and unreserved statement to that effect in the notes that it complies with international standards. What is this going concern concepts and accruals basis? Where financial statements are generally prepared on the going concern basis unless the entity intends to cease trading or has no realistic alternative but to do so. So the financial statements are prepared on the basis that the company will live forever. So the only limitation, therefore, is the items within the financial statements. This was clearly explained last week. For the accruals basis, financial statements other than the statement of cash flows should be prepared on the accruals basis. What this simply means is that for income, you recognize an income when that income is earned, not when you receive it. So if you make a sale of 10,000 and you've only received 8,000, you recognize 10,000 as income, not 8,000. So the remaining 2,000 becomes receivables. Similarly, expenditure are recognized when incurred, not when they are paid for. So if a business incurs an expenditure worth £5,000 and only paid 4,000 out of that during the year, then the whole of the 5,000 is recognized. Accruals basis also means that revenues will be matched with the costs that have been used to produce the revenue. So, for example, if you bought a piece of equipment that you are going to use for 5 years, then the cost of that piece of equipment will be spread over 5 years as you use the equipment to produce revenue. This is what accruals basis mean. Materiality and aggregation. Well, items are material if they could influence the economic decisions made by users on the basis of the financial statements. So in that case, the item is material only if it has the potential to influence economic decision. Each material class of similar items should be presented separately in the financial statements. If an item is not individually material, then it may be aggregated with other items. The requirements of international standards need not be followed or applied to items that are not material. Offsetting. In general, assets and liabilities should be reported separately in the statement of financial position and should not be offset against one another. For example, if a customer buys a good from you, some goods from you, and the customer owes you £10,000, and you also acquired some products from the customer, owing that customer £4,000, you are not allowed to show £6,000 due to you. So you cannot offset the 10,000 with the 4,000 to leave a net amount of 6,000. Instead, you should show an asset of 10,000, which is receivables, and a liability, payables, of 4,000. They must be shown separately in the statement of financial position. Similarly, income and expenses should also be reported separately in the statement of comprehensive income. However, this rule will not apply if offsetting is permitted or is required by an international standard. If the international standards permits the offsetting of such items, then they can be offset. Or perhaps if there is an agreement between you and the customer for such offsetting to happen. What about the frequency of reporting? where financial statements are normally presented at least once a year. At least once a year. If for one reason or another, the financial statements cannot be presented once a year, then the company or the entity must disclose the following. 1. The reason for using a period that is longer or shorter than 1 year. And 2, the fact that the comparative amounts given for the previous period are not directly comparable with those given for the current period. So that must be explained to give users some understanding as to why it is not for a full year. And of course, whether certain adjustments need to be made to the comparative figure to make them comparable. Talking about comparative information and consistency of presentation. As a minimum, entities should present comparative information in respect of the previous period for all amounts reported in the financial statements. So if the financial statement is for a period to 31st of December 2019, then all information in respect of the period to 31st of December 2018, which is the previous year, must be presented as well. In order to maintain comparability, the way in which items are presented and classified should generally be consistent from one period to another. So in that case, comparability is enhanced. Now that we've looked at the format, the formal contents of the forms of the accounts, let's have a look at the content. First of all, identification of the financial statements. The name of the reporting entity must be conspicuously displayed. So that name must be shown so everyone knows the name of the reporting entity. It must be shown whether this financial report is for a single entity or a group company. The date at the end of the reporting period and the period covered by the financial statements must be displayed. The presentation currency used, whether it is sterling, euro, or whatever the presentation currency is, and the rounded level used, either in thousands or in million. Let's now focus on the statement of financial position, otherwise known as balance sheet. This week, you will get the opportunity to practice the first set of accounts. Basically, this is to try and hone in on your earlier knowledge in this area. The statement of financial position was formerly referred to in the standards as balance sheet. It will have current and non-current assets. So you have a distinction, a breakdown between non-current assets and current assets. Similarly, you have current liability and non-current liability. It must contain information that must be presented in the statement of financial position. There are certain information that must be presented there. And there are other information that may be presented in the statement of financial position, or perhaps relegated to notes, or simply by way of note. Let's look at the distinction between current and non-current. First of all, we focus on an asset. If you remember last week, we defined assets as a resource controlled by an entity as a result of past events. So now we are looking at the types of assets. An asset is current asset if it satisfies any one of the following criteria, any one of those four. First, it is expected to be realized within the entity's normal operating cycle. So if the normal operating cycle is 6 months, then the asset is expected to be realized within that cycle. If it is 1 year, then it is expected to be realized within the next 1 year. It is held for the purpose of being traded, like inventory. So that would be a current asset. It is expected to be realized within 12 months after the reporting period. It is cash or a cash equivalent as defined by IAS 7, Statement of Cash Flow. All other assets that are All other assets not meeting any of these criteria will be referred to as non-current assets. So if you're able to define current assets, the rest will be non-current assets. So non-current assets would be, for example, property, plant, and equipment that is used for a period of time over more than 1 year will be non-current assets. So if you know these 4 criteria, then if it does not meet any of these 4 criteria, it must be a non-current asset. In terms of current liabilities, similar approach is used for the definition of current liabilities. So a liability is a current liability if it satisfies any one of the following 4 criteria. 1, it is expected to be settled within the entity's normal operating cycle. So like I said earlier, if the operating cycle is 6 months, it is expected to be settled within that 6-month period. If it is 12 months, it's expected to be settled within 12 months. It is held for the purpose of being traded. It is due to be settled within 12 months after the reporting period, and the entity does not have the right to defer settlement for at least 12 months after the reporting period. Again, all other liabilities are non-current liabilities. So if the liability does not meet any of these 4 criteria, such a liability will be a non-current liability. Debentures are typical examples of non-current liabilities, or bank loans for more than 12 months are non-current liabilities. Examples of current liability would be trade payables, accruals. These would be examples of current liabilities. What sort of information content can be presented in the statement of financial position? So in the set of statement of financial position, you have non-current assets, which will comprise property, plant, and equipment, investment property, intangible assets, financial assets. Then you have current liabilities such as inventories, trade receivables, cash and cash equivalents. Trade payables will be current liability. Provisions, again, this may be current liability, but mostly non-current liabilities if they are more than 1 year. Financial liabilities, tax assets, and tax liabilities. Then you have equity, capital, and reserve. There could be subclasses within each of these classes. So subclassification of line items as appropriate to the entity's operation and or as required by other international standards. For example, the property, plant, and equipment could just simply be left as one item, which is property, plant, and equipment, instead of showing them separately as plant, equipment, motor vehicles. Under IAS 16, property, plant, and equipment, they could be shown as one item. An analysis of share capital and reserves. Let us now display a typical statement of financial position for your understanding. So the statement of financial position at 30th of June X6, 20X6. So you can see that starting with non-current asset, you have property, plant, and equipment, intangible assets. You could also have investments, properties as well. For current assets, you have inventories, trade and other receivables, cash and cash equivalents. When you add that together, it then adds to the total, so you have total assets. These total assets, which is this figure of total assets, must agree with total equity and liability. So the next will show the total equity and liability. So this is the equity, which is made up of share capital, share premium account, retained earnings, revaluation reserve. Total equity, you add to that the total liability, which is made up of non-current liabilities, long-term loans, debentures, for example, current liabilities, which is trade and other payables, bank overdrafts, trade payable. So that's total liabilities. And when you add that to equity, you have the figure of total equity and liabilities, which will equate, which will be equivalent to total assets. So that's basically the format of statement of financial position, which I believe most of you are probably familiar with, but you need to familiarize yourself with it, and we're going to practice some questions using this format. In terms of the statement of financial performance, we will focus on the statement of comprehensive income. Remember I said that this one was referred to as statement of profit or loss and other comprehensive income. So we'll continue now to refer to it as statement of comprehensive income. All items of income and expenditure recognized in an accounting period must be presented in either a single statement of comprehensive income, which is the format we are going to be using, or you may have two separate statements. And these statements will comprise one statement showing the components of profit or loss, and the second statement beginning with the profit or loss for the period, and then showing other comprehensive income. As I said, in terms of this particular module for this semester, we will focus on the first format, which is a single statement of comprehensive income. Now, what are the components of this statement? You begin with revenue. Some call this turnover or sales. So you have revenue, finance costs, tax expense, profit or loss from discontinued operations if the company has ceased certain part of its operations during the period, profit or loss for the period, each class of other comprehensive income, and total comprehensive income for the period. The first five of this list, which is from revenue to profit for the period, may be presented in a separate statement of profit or loss. But as I said, we will be presenting all of them in one comprehensive statement. So what are the items to be presented in the statement of comprehensive income, or perhaps presented by way of note? Further items of income and expense should be disclosed separately if such item is material. If that item is material, then it must be disclosed separately. An analysis of expense should be presented using a classification which is based either on the nature of the expense, or it may be based on the function of the expenses within the entity. So, for example, cost of sales, distribution costs, administrative expenses. Manufacturing companies normally disclose the items on the nature of expenses, but for our purpose, we'll be using the function. So we have revenue, cost of sales, distribution costs, administrative expenses. So we focus on the function instead. Entities are encouraged to present the analysis of expenses in the statement of comprehensive income. They may well present this in notes if they so desire. Here's a typical example of a statement of comprehensive income. So you can see from this example, we start with revenue, less cost of sales to give us gross profit. And after that, you have distribution costs and administrative expenses. These two together are operating expenses. So distribution costs, administrative expenses. Once you deduct the operating expenses, you have profit from operations. And you can add other income to that. For example, if you receive dividend from another company, so you have investment income, which you add to profit from operations, and then you less finance costs. By the way, finance cost is interest paid by the company. So that will be finance costs. Once that is deducted, you then have profit for the period. And from that item, profit for the period, you deduct income tax expense, which is that figure, to give us the profit for the period. Now you're going to continue with that statement. From the profit for the period, you then look at other comprehensive income. Mainly, these are items that have nothing to do with the operation of the business. A typical example is revaluation gain. When you revalue a non-current asset at a gain for the first time, the gain is taken to other comprehensive income, which comes here. It could be a gain on foreign exchange. Again, for your purpose, we are going to focus mainly on revaluation gain, and no more. Another type of item that may come here would be financial instruments that is stated at fair value through other comprehensive income. Again, that will not feature here. So as far as you are concerned, any revaluation gain would appear here on other comprehensive income. When you add that to the profit before, that gives us the total comprehensive income for the year. Note at the bottom that there is more formalized terminology, and only certain headings and amounts are required to be disclosed in the annual financial statements. The capital structure of a limited company is different to that of a sole trader or a partnership. We are not concentrating on sole trader or partnership. This is purely for limited company. So, the final statement is a statement of changes in equity. In the next video, I will show you a format of that statement. In essence, the statement of changes in equity shows how each component of equity has changed during an accounting period. So items presented will include the total comprehensive income for the period, which we've just discussed in the previous section, effects of any changes in accounting policies, so prior year adjustments, for example, share issues if the company issues new shares during the year, and of course, dividends paid during the period. So this statement provides a reconciliation of the opening equity and the closing balance of each component of the equity. Finally, notes to the financial statements. This will show how each component of equity has changed during an accounting period. Items presented will include total comprehensive income for the period, the effect of any changes in accounting policies, any shares issues and dividend paid. All of this will be shown by notes explaining what has happened during the year. It will also provide reconciliation of the opening and closing balances of each component of equity. In summary, a complete set of financial statements consists of statement of profit or loss, statement of comprehensive income, statement of changes in equity, and a statement of cash flows. Transactions and items should be faithfully represented in the financial statements. Financial statements should be prepared on a going concern basis using the accruals basis. The presentation and classification of items should be consistent with disclosure of comparative information. IAS 1 does not specify a particular format. There has to be a distinction between current and non-current assets as well as liabilities, and this must be shown separately in the statement of financial performance. The statement of changes in equity shows the changes in each component of equity during an accounting period. This brings to conclusion the first video for this week. The next video, you will see an example of the statement of comprehensive income, and then we will look into accounting policies, accounting estimates and errors, which is under IAS 8. Thank you for listening, and I'll see you in the next video.